I do not think, and I may piss people off, but I don't really care. I don't think anyone's ever going to care about Bitcoin per share at the institutional level in any way that's going to make them change their decision-making process around these equities. I think that the ultimate arbiter of who's going to invest in what is how much money is this going to make me. Bitcoin per share is a KPI about efficiency of capital allocation. Fine. That is not a KPI about efficiency of return. So I think that I think strategy is, they're balancing who they're communicating with. They're communicating with the retail investment group, but they're also trying to gain favor and gain an additional footprint in the institutional world as well. And I think that the institutional world has an entirely different set of KPIs versus the retail investors. And that the only KPI right now that I think that everyone is like uniformly interested in is how much is Stretch going to grow, how much is SATA going to grow, how quickly are these things going to get to scale, are they going to be able to pay the dividend? If we're talking about the preferreds, I think those are the KPIs. When it comes to the equities themselves, it's going to be price performance. Not going to be Bitcoin per share, application ratio, or anything like that.
I mean, if Stretch is extremely successful, then automatically the Bitcoin per share will be good, and automatically, not automatically, but like very likely, strategy will also be. Is that what you're kind of saying, that you're more likely to watch if you? It's better to watch what Stretch is doing from volume perspective and how successful it is. And then kind of the second order effect is that the Bitcoin per share is going up because they can raise capital, they can raise Bitcoin. And then the MNAV maybe might be more interesting because they have a very successful preferred equity also.
So those are two separate questions. So the first part of the question with regards to Stretch, and this kind of ties into what Chase was saying. Let's say that Stretch is very, very successful and they're able to, well, not let's say it is. It has been very, very successful. And let's say that we're still in a bear market and this continues and Stretch is successful and they're able to ATM and buy Bitcoin, right? Bitcoin per share is going up, but share price is doing this. That doesn't really matter. You have more Bitcoin per share, but you don't have any claim on the Bitcoin. So again, it is a KPI about capital efficiency and how efficient they are at acquiring Bitcoin and the cost of that Bitcoin and how it can be represented on a per share basis. But that is not a direct correlation to anything having to do with value. It is an efficiency metric in the case of Bitcoin per share. And also something that people don't really pay attention to is that it's actually a metric of decay. Bitcoin per share has nowhere to go but down over time because Bitcoin is a finite asset. And shares are always going to go up. So Bitcoin could be successful, which it is, and be extraordinarily successful. But if Bitcoin is ripping to 250, 500, and 100 and $1 million a share, a coin, Bitcoin per share is going to trend down, right? So is it trending down? Is that a bad thing? Or do you see what I'm saying? Bitcoin per share is a metric about efficiency. So that's the first part of the question. The second part of the question, this is something I'm going to keep hammering until people like really get it. MNAV is about market sentiment. It has nothing to do with anything that strategy does. There's no lever that they can pull that's going to make that MNAV go higher. That's going to be directly correlated to market conditions, sentiment around Bitcoin, sentiment around strategy. And if you, like what I've done with MNAV over the last, since like August 2020 to now, is that I've modeled it out. Strategy has been in very, very persistent and observable compression and expansion regimes when it comes to MNAV. And those tend to decouple from Bitcoin and move more tightly with Bitcoin depending on market conditions. So again, is MNAV by itself, just like Saylor said in the earnings call, market sentiment, market belief, perception around the equity, around the preferreds, that's going to drive belief, that's going to drive the reflexivity, and that's going to drive MNAV higher.
Adrian, would it be fair to say that when looking at Bitcoin per share growth compared to traditional ways that we value equities, that you think about it as basically IRR or something like profit margin, where it doesn't necessarily speak to the market cap or the the growth of the per share price. It's really just about efficiency of operations.
It is about efficiency because, and this is not me saying it's an invalid metric. This is me saying what it is a metric of, in my view. So Bitcoin per share, one of the reasons why I don't really necessarily consider it at all is because I don't have any claim to Bitcoin. Even in the case of a liquidation event, it is not as if they're going to give me a proportionate amount of Bitcoin per share. I'm going to be paid out in cash. So from a standpoint of value, I am tracking something I have no claim to. So that's the first reason why I consider it a measure of efficiency and not value. The second point is, if we are trying to compare to traditional metrics, we have to be very, very careful about what we do. The BPS EPS comparison, that's something that has been said. The problem with that is EPS is driven by operational revenue. It's driven by operational income. It's driven by operational growth. In the case of a Bitcoin treasury company, the growth is tied to the underlying asset. So that is net asset value accretion mentioned and measured on a per share basis, but that is not earnings per se. It can be reported in a similar fashion. It could be seen as that way. It can be a mental benchmark for that. But if we are being very logical and honest about it, BPS, EPS, or BPS doesn't really track to traditional metrics. That's why I say that we have to view it as a KPI. How efficiently they're using the capital, whether it be from the preferreds, whether it be from the common, to accrete Bitcoin that's going to grow the net asset value of the company, not the per share metric of that asset. Does that make sense?
Yeah.
And the issue with Bitcoin per share is also the fact that it does not include the claims to it, right? It does not include the preferred claims or the debt claims to it. That's why I really like the CEB tracker, because it does net out the debt obligation and the preferred obligation. I also agree with you that because Bitcoin per share or Bitcoin yield will naturally asymptotically trend towards nothing because of the hard cap nature of Bitcoin, I think eventually MSTR will need to change that narrative, because still, if you were to listen to the latest earnings, their true north metric is Bitcoin per share. But eventually, I think they'll need to change that narrative to say the biggest stack is that much more capitally efficient to acquire the next available Bitcoin on the market. And so I have yet to see them signal that. But to me, that makes the most amount of sense.
I think that, and this is why I'm being very, very fair with what I'm saying. And this is why I always try to differentiate between who they're communicating with. Bitcoin per share is for the retail community. That is not for institutions. That is just my view. I think that strategy is constantly having to navigate between the different groups that they're communicating with, and they have to find messaging that resonates with each group. And to your point, Peter, I think that inevitably Bitcoin per share and Bitcoin yield is going to be something that they trend away from. But also, as a Bitcoiner, and again, this may piss people off, but again, I don't care, using Bitcoin denominated valuations doesn't make any sense. That assumes a world where everything is on a Bitcoin standard. And by definition, if you are in a Bitcoin treasury company, or you're trying to value Bitcoin treasuries, or you're using Bitcoin as the denominator, you are begging your own question. You are changing the measure to a measure that supports your thesis. But what is Bitcoin priced in? Dollars, yen, pounds, euros. Bitcoin is and always will be priced in fiat currency, whether we want to accept it or not. So I think that while it is beneficial to have Bitcoin-centered, Bitcoin-focused, Bitcoin-denominated KPIs, the reality of it is that even if we were going to go to a hyper-Bitcoinized world at some point in the future, we need to have a realistic appraisal of where we are now. And the valuation metrics and the KPIs that we use should be trended towards the now with an eye towards the future.
Yeah, it's like
sorry, real quick. I just had a question to Adrian because you were saying that if the Bitcoin related KPIs don't matter and you're an institutional investors, you care about the volume growth on Stretch, for instance. But yet you also say that these preferred Stretch and other preferreds have no claim to the Bitcoin, then why would an institutional investor care about the volume of Stretch? Since the Stretch volume could be high, but the common shares could actually trend downwards as well. So, what as an institutional investor would you want to invest in MSTR in that case?
Well, the reason is because, and this is one of the reasons why I've been hammering the point about MNAV and so on and so forth. The entire market for strategy right now is driven almost solely by options. The interest in strategy is heavily in the options market. A lot of the volume that we're seeing is being driven by the dynamics in the options market. Going back to, I think it's August of 2024, the last time I did the analysis, a fully 25% of the price action in strategy is attributable to the options market. So that is what institutional investors are interested in. Strategy is, people classified it as a beta Bitcoin play, right? Which is accurate. The movements bear that out. The game that's being played is in the derivatives market. At several points, the open interest in strategy has been larger than the market cap of the company. Strategy has had share volume on par with Tesla in the options market globally, on par with NVIDIA, on par with a lot of Mag 7 companies. And their market cap hasn't really moved in proportion to that. So what that tells me is, when I look at the data, when I look at the market, and when I look at what I'm doing myself, the reality of strategy as an equity is a leveraged beta options play to Bitcoin. People are betting on Bitcoin with leverage through strategy. That is what institutional investors are interested in. Go ahead.
Sorry, do you foresee that to continue to happen, or do you feel like as Bitcoin gets bigger, they're going to that percentage volume on options divided by the market cap is going to dwindle, and therefore there'll be less.
It's only going to get bigger.
It's only going to get bigger
Exponentially. So as Bitcoin's price grows, the interest in strategy will grow exponentially, and the options activity is going to grow exponentially. So to give you so open interest overall has been bigger than the market cap of the company itself. Gamma exposure, so that's how market makers hedge. That's been a fraction of market cap. So what that means is a fraction of the market cap of the company was being used to hedge against the company. That's a very, very unusual dynamic for an equity that hasn't crossed a market cap of 120 billion yet. That you see that at times with NVIDIA or Tesla, because this is something that I watch when I'm doing my analysis. When I say that the options market is driving everything, Mag 7 and strategy, and now that semiconductors and so on and so forth, when you're seeing the explosive growth in these equities, the explosive growth is being driven by volume and investor interest, yes, but the real push, the real volatility is being played out in the options market. Realized volatility is at the price level, implied volatility is at the expectations about price, and that's what's pushing things. That's what's creating the wild oscillations in amplitude. So strategy is going to be, in my view, the vehicle for Bitcoin exposure at the institutional level, more so than Bitcoin in a lot of ways. I thought, go ahead.
I was just asking, do you also think that Bitcoin volatility then will go up?
I think that Bitcoin's volatility, ironically, will go down. It will not be, I think we're a long ways away before Bitcoin becomes, I don't want to say stable, but where we're not going to see it go to 126 and then down to 70, right? However, this is my view. I think what Saylor has done, and he's been telegraphing this the entire time, volatility is vitality. He's making strategy the vehicle for Bitcoin exposure for the world. That's what he's doing. I think the end game is that he's going to financialize Bitcoin to such an extent that no matter what happens, strategy is going to succeed, because he's a believer in the Bitcoin thesis, as we all are. So let's just think it through logically. Bitcoin's at what, 79, 80K, whatever it is right now. Let's go into a future where Bitcoin is at 250K. Strategy owns 1 million Bitcoin. Their market cap is ridiculous, right? Do you think, Peter, coming to your point, it is more likely that people are going to say, I'm not going to bet on it now, it's too big? Or because it's much larger, I'm going to place much larger bets?
Yeah, I'll place larger bets. But my curiosity is that you used NVIDIA and Tesla as examples of large open interest ratio to the market cap. But if you look at, say, for instance, like both of those, they actually have, Tesla's actually has been rather muted, in a relatively narrow range, while NVIDIA has been up and to the right, but because MSTR has amplified Bitcoin, I can see that actually, where like it's going to be really violent and really on both directions for quite some time. So that's yeah. As we're talking this out, it actually makes a lot of sense that you see institutions' involvement in MSTR as a volatility vehicle, much less than kind of a long only type of strategy. Is it? Did I get that correct?
Yeah,
Okay.
institutions are using strategy as a volatility play. Another data point, what do you think the ratio is between the heaviest ATM issuance and the heaviest daily short volume?
No idea.
30. There's been 30 times the daily short volume than there has been ATM issuance at the heaviest point. That's the actual ratio between the two. So the heaviest short interest at any point since August 2020 to now has been 30 times the heaviest ATM issuance. Why do you think that is? That is convertible bonds over a longer period of time, hedging. That is also because there's heavy betting in the market saying we think this is going to fail, and we're going to bet that it's going to fail. That's what short interest essentially is. On the daily level, the short interest that we're seeing on the longer term level from the convertible bonds is, I differentiated between stock and flow. The longer term short interest from the converts is stock. That's consistent. The daily short volume that we're seeing is flow. That's what you're really seeing in the market in terms of sentiment, in terms of what they think about the equity. So at two levels, I am seeing consistent options market activity that even when it dies down, it's still in the top 10 or top 20 globally.
Yeah.
And I'm seeing short interest that's oscillating and going on a very, very, it's not systematic, but it's a very apparent regime. And the analysis that I do on strategy, I do an analysis from everything from the equity to Bitcoin to the options market. And Chase, you're going to go in a hot second here. I just want to get these three last points out. One, even when MNAV has collapsed, the volatility ratio between MSTR and spot Bitcoin has relatively been 2. So it's still been twice as volatile. So when everyone hears about 2x Bitcoin, they focus on, well, that should be 2x MNAV or 2x performance. But like you just pointed out, to the downside, it could be 2x as well. And that's where the 2x volatility tends to maintain itself. The options market, with the volume of a company being a fraction of the size of NVIDIA and Tesla, still having top 10, top 20 options volume, that says to me that it is a volatility play. Tesla, NVIDIA, they're volatility plays. I mean, I just ran it the other day. NVIDIA's average trading volume is something like 30 billion a day, and you can see anything between 3 and 6 billion of that being short interest. So that's obscene, right? So that's the second point. The third point is, going back to what you were asking, Peter, as Bitcoin grows, as strategy will grow. As Bitcoin and strategy grows, and as Bitcoin's footprint becomes more steady state, they're going to have to go to a different vehicle to get that volatility. Institutions were using Bitcoin directly through the futures and through all their shenanigans up until, I want to say, 2024. I can almost see it like it's a dead mark on a calendar. Mid 2024, that shifted. And the options, you started seeing everyone on Twitter talking about options on strategy. Everyone was talking about covered calls. Everyone was talking about how I'm using strategy to get premium, to farm premium, so on and so on and so forth. I think strategy is going to be the levered vehicle for Bitcoin going forward and into the future, more so than IBIT, more so than Bitcoin itself, more so than the futures market. I think that is what's going to be one of the end goals that's coming.
That's very interesting. This is, oh, sorry, go for it, Jason.
Yeah, let me just jump in on that. So 30% short interest, Adrian. So what should we expect there when strategy eventually retires the converts? Because now you have less of that hedging, but does that maybe also negate some of the short narrative because now they can claim that they are debt free as well as the Bitcoin being unencumbered, and maybe it actually wipes out some of the short interest that remains post-convert hedging?
Well, the short interest was never because of it. The Bitcoin's always been unencumbered, right? So
Right.
The short interest isn't about, and let me be specific here. Short interest is stock. That's the constant short pressure that we're seeing from the convertible bonds. Daily short volume, what I'm talking about, the 30x, is flow. That's what we're seeing on a daily basis. That's the daily amount of shares that are being sold short, okay? So in terms of, let's talk about what the difference is between the two of them. That consistent short pressure when the converts are eventually bought back, that will dissipate. However, that is not tied to necessarily a narrative. That is tied to, we gave you $1 billion, we gave you $3 billion, we're going to hedge our bet.
Right.
So structurally, that's a different consideration. The daily short volume, I think, is where most of the shenanigans happen. The gamma exposure is where a lot of the shenanigans happen, and I think that the ratios can stay relatively the same.